Going back to 1945, the S&P gained on a total return basis 9.2% for all years. Whenever the market was up in January, however, the total return was 16%, and the market was higher 86% of the time versus the more normal 72% of the time. So rather than simply getting a return that is smack in the middle between tech and consumer staples, actually you ended up with 93% of the return of tech, but with 40% lower volatility. Only 15% of bull market days have 1% moves, whereas close to 45% of bear market days have 1% moves. Looking at the 1 year period after the last rate hike and the first rate cut, the S&P gained an average of 18%. Yet in the 12-month period after the first rate cut, the market gained an average of only 5%.
Hi, Sam. Thank you very much for joining us today.
I'm happy to be here.
Jack and I have followed your work for a long time, and we always have appreciated your combination of like deep market expertise, your views on sectors, and also sort of just the data-driven insights that you sort of bring to the investment community. So, we really appreciate that. And what we thought we'd do with you today is work through your 7 rules of Wall Street, which are some of the most important rules and lessons that you've learned throughout your career. And these are topics that you actually discussed in a book you wrote. The book was, a few years ago, but still sort of very relevant, I think, to just the markets today and in the long term. So this is going to be a good conversation. We're looking forward to it. Our listeners can follow you on X, also Twitter, which some people refer to it still as. You're at Stovall, CFRA. And then obviously your research can be found on CFRAresearch.com. Okay, so let's get into it. The first rule that we wanted sort of to put out here is, number 1, let your winners ride, but cut your losers short. So it's kind of obvious, I think, what you're getting at, but I'll let you explain.
Sure. Well, a bit of a preamble to all of this is I wrote the book because the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." And I know my limitations are that I can allow my emotions to become my portfolio's worst enemy. So my thought was, how can I convince myself to embrace a rules-based investment approach and thereby extract my emotions from this equation? Because in this day and age of instant information, I can experience both fear and greed at the exact same moment. So how can I get rid of that? Well, that's why I looked at the 7 rules. And the first one, as you said, is probably one of the more popular rules. That is, let your winners ride, but cut your losers short. Because frequently I am asked in the beginning of every year, gee, should I buy last year's winners or should I buy last year's losers? Buy low, sell high. Well, I figured let's go to the drawing board. Let's take a look at the numbers. And what I found was that going back to 1990, which is as far back as S&P has sector and sub-industry level data, in general, you are much better off buying last year's winners, the 3 best performing sectors and the 10 best performing sub-industries, because instead of a total return average of 10.3% since 1991, the 3 best performing sectors gained 13%, and the 10 best performing sub-industries rose 18%. So, and also when you look at frequency of beating the market, I'm like Pavlov's dog. I want to be fed frequently. And so I want to know that whatever technique I'm using works more times than it does not. That both of these techniques, meaning sectors and sub-industries, beat the market more than 7 out of every 10 years.
That's great. So if we were to look at today's market, what sectors or subsectors or industries do you believe are the current winners that are worth riding here?
Current winners are communication services, financials, and technology. And in some ways, you could sort of wonder, gee, is this spreadsheet updating? Because it seems to be frozen in place, or at least it has for the last several months, and at least for tech and communication services for the last couple of years. So I guess you basically ride that winner until itself gets exhausted.
Do you have any concern or sort of issue with the level of concentration though in the market? I think like maybe the S&P 500, the top, handful of stocks make up a very large portion of the index. So how do you kind of think about that in terms of risk?
Yeah, I mean, I do worry about that because technology plus communication services, is more than 40% of the S&P 500's market cap weighting, more like 45%. And so you hearken back to other periods when the market declined precipitously, and you say, gee, maybe I'm better off being in mid caps, small caps, equal weight, or whatever. Unfortunately, except for when the bubble burst in 2000, whenever we did have a negative full year for the cap weighted 500, these mid, small, and equal weight indices did even worse. So unfortunately, it's like whitewater rafting. You have to let the market take you where it wants to go and just hold on tight.
So this next one might be good news for all of us. I'll let you answer that after, but the rule is as goes January, so goes the year.
Yes. Well, this is one of those indicators that I believe I was first introduced to by the Stock Traders Almanac. And basically, it's a very good indication to see how committed are investors to an up year for the market by putting their money to work in January. So getting a good positive read on the market has been very helpful. And at the same time, if the market was down in January, then for the full year, the market was essentially flat to lower, down 1.7%. And it was a coin toss. 48% of the time, the market was higher after a down January. So, usually it's a good indication more of the bullishness trend rather than the bearishness one.
How do you think about the current market from this perspective? I mean, we had a pretty good start to the year, then we had some hiccups, to say the least, and now we're going again. So how do you view the current market in light of all this?
Well, what's interesting is 2025 was very different from 2023. 2023 followed the 19.5% calendar year decline for the S&P 500, knowing full well that we've only had a handful, maybe two times in which the market declined year over year, two successive years or more, going back to World War II. So historically, the market tends to do better the year after a decline. So with that in mind, and then adding the fact that we had a positive January barometer in 2023, and the first quarter return decline did not undercut the prior December's decline. As a result, that indicated to me that 2023 was likely to be a very strong year because the average total return was 25% and the market rose 100% of the time. Now, of course, that's not a guarantee, but it's a pretty comforting indicator to say that following this down year with investors willing to put money to work pretty quickly, that implies we're going to have a strong year. And basically 25% was the total return we got in 23. This year, however, yes, we had a negative Santa Claus rally, but we had a positive first 5 days. We had a positive January barometer, but then we undercut December's low in the first quarter. So you had a lot of mixed messages coming at you, but that typically happens in the third year of a bull market. And not surprisingly, we ended up with a near bear market decline of about 19%.
And you've done some work on this, right? The third year of a bull market is usually a challenging one, correct?
Absolutely, because going back to World War II, we've had 11 bull markets that celebrated their second birthday. So taking those 11 and saying what happened 12 months later, the average gain was a little more than 2%. All right, let's take out those 3 times in which the second year bull did not celebrate its third birthday. Well, in that case, we were up a whopping 5% because we had 2 more years in which the market posted a decline, but not enough to be a new bear market. And then 3 more times in which the gain was 6.5% or less. So essentially the third year, it's like child rearing, it's the terrible twos, and the same with investing. So until we get beyond the third year and into the fourth year, which will start in the first half of October of this year, investors have to keep reminding themselves it's like demographics. You make it to 65, you've got a great chance of making it to 75 and 85, because once we survive the third year of this bull market, the fourth year tends to be strong, better frequency of advance, as well as an average gain of close to 13%.
How do you think about AI in the market? Because this is one of the things that's challenging for me. I'm a value guy, so I'm always worried about everything. I'm like tariffs and recessions and all that stuff in it. But part of me looks back to like the 90s, and I was completely wrong about that whole thing. And I think about like if I'm just missing something, that if AI is really as big as it could potentially be, like is the market just going to see through all this stuff? And we're, potentially going to have a big, massive run that I'm going to miss again. So I'm just wondering if you have any thoughts about AI in general in the market.
Well, I guess, in some ways I am similar to you in that I wear both suspenders and a belt. And so, value people say, I want to make sure I get a good value for my dollar. Well, the growth really has been in the technology space in general and in the AI area in particular. I mean, if you just take a look at second quarter earnings, S&P 500 was expected to post only a 2% gain, according to S&P Capital IQ. Now it's doubled at 4%, but tech is at 17%. For all of 2025, tech is still at about 17% versus 7.5% for the overall market. And again, a mid-teens plus gain expected for 2026. A lot of people talk about AI being in the early innings of a baseball game. Some would actually say it's not even out of batting practice yet. So I think that's in a sense, the hype that keeps this market aloft. And I think until the AI companies disappoint, then whatever dips we get are going to be bought because investors have been reminded that, we're not done yet with AI. There will come a point, however, in which AI needs to bring in the money, not just be the recipient of additional capital expenditures for growth.
The third rule is sell in May and go away, but rotate rather than retreat. Can you explain that one?
Yes. Well, we all know that since World War II, the S&P gained less than 2% in May through October, but advanced about 7% from November through April. And the November through April timeframe beat the May through October period about 2 out of every 3 times. Plus the old saying, sell in May and go away, do not return until St. Ledger's Day. So, the thought is, okay, well, gee, if I'm going to focus on my TAN versus my portfolio, then do I really want to walk away? Not really, because the market has had some very nice returns May through October. And so you don't want to be out of stocks. Historically, the better sector performances have come from the defensive areas, such as consumer staples, healthcare, utilities. Like the old saying, when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. But in the November through April period, you want to focus more on the cyclical areas. Yet a little caveat is that seasonality has been put on its head since COVID. That, the seasonality aspect really has not been working all that well, primarily because tech has just been so strong for all months of the year. And also right now, because of the tariff worries, healthcare is continuing to take it on the chin and is underperforming. So certainly not helping any investors who might have rotated into these defensive areas most recently.
That idea of tech continuing to do well gets into my next question, because as I mentioned, I'm a value guy, and we would love to see value investing have its huge run that we've been calling for the past decade. What are your thoughts on the struggles of value investing, and if there's some optimism for that type of strategy going forward?
Well, yeah, I guess I am sort of a believer in reversion to the mean. I do think that value will have its day in the sun once again. Certainly, if we find that technology gets to a point that it is a little bit overbought, if you will. I mean, right now, technology on a 20-year basis is trading at a 63% premium on its forward PE versus its 20-year average. The S&P is trading at a 40% premium over the past 20 years, and the S&P itself is trading more than 2 standard deviations above the mean. So it's almost like the old crooner Brooke Benton, who once sang, "It's just a matter of time." But I think right now, what's happening is, recommendations would be stick to, your knitting. If you happen to be a value investor, then stick with that. Focus on high quality companies. How do you define a high quality company? Well, very simply, you could use the S&P earnings and dividend quality ranking. It's a letter grade, A minus, A plus is above average to superior. Take a look at those companies that offer a nice dividend yield, maybe 3% or more, but have a payout ratio of maybe 70, 75% or less. So, how can you go wrong, especially when you reinvest those dividends? You basically set it, you forget it, they are going to advance, and they're going to hold up an awful lot better than the high growth, high beta areas once the market does finally digest these gains.
I'm curious. One of the things I think I missed about the Mag 7 is just the quality of these companies, going back to quality like you talked about. I mean, do you think in a lot of ways, it seems like the way they behave now, they're almost like the consumer staples of this generation? I mean, do you think that's right?
Yeah, I remember one of our consumer discretionary analysts used to say that Coach should be a consumer staple because every woman needs a new handbag to go with their outfit. And in some ways, you could sort of say that tech is that way as well. I mean, NVIDIA continues to outperform, is expected to post a more than 150% increase in earnings when it does report later in this reporting period. Other tech areas are expected to post anywhere from 20 to 40% year-on-year gains on a sub-industry level. So, until that ends, that consistency makes investors feel like, I just should set it and forget it. But I think, as trees don't grow to the sky, I don't think we're going to be seeing that kind of tremendous earnings growth as we have in the past. I think that as we move into 2026, growth for the Mag 7 will equal that of tech, not surpass it as it is projected to do in 2025 and certainly in this second quarter.
So your first rule is there's a free lunch on Wall Street if you construct your portfolio right. So can you explain that one?
Yes. Well, my thought was, it's like going to the amusement park to have fun. I know I have to go there, but do I always have to be on the roller coaster? Couldn't I sort of be in the teacups part of the time? So when you think of what is the poster child for growth, well, that's technology, but it's also the poster child for volatility. What is the poster child for stability? Well, that's consumer staples, food, beverage, tobacco, because the demand for these products and services remains fairly static, whether times are good or bad. So just for fun, what I did was I said, well, let's put together a portfolio, 50% tech, 50% consumer staples, rebalanced annually. Gee, I wonder how you would have done. The first thought is, well, if tech is on top, and consumer staples is on the bottom, you'd get a return that was in the middle. Well, not really, because that is, if you look at it on an equal weighted basis, but on a compound annual basis, what you find is that both sectors take the stairs at different rates of pace. So rather than simply getting a return that is smack in the middle between tech and consumer staples, actually, you ended up with 93% of the return of tech, but with 40% lower volatility. And as I had mentioned, it's simply because staples does well when tech does poorly and vice versa. And actually, if you look to the overall asset value of this hypothetical portfolio at the end of 2022, the portfolio's CAGR beat that of tech alone. Meaning from 1990 to 2022, this portfolio had more money in it than tech itself, even though you rode the very sharp ups and downs of that roller coaster. So I would say an investor who wants to be able to sleep better at night, but also have a toe in technology, might want to consider this kind of an approach.
It's funny you mentioned the roller coaster because I'm taking the afternoon off today to take my daughter to the water park, and she will be the one doing the really steep slides, and I will be the one on the equivalent of the teacups, whatever that is. So the small slides. I would also think with that tech and consumer staples thing, I would think rebalancing is probably a huge part of that return, right? Your ability to buy whatever's out of favor and rebalance back.
It is. And the good thing about this very simple strategy is that you don't need to incur capital gains, because all you do, like topping off a beer, is add to that sector that underperformed the year before. So, if you have some money, just simply add to that every year, the side that is not equal. And then that way you're not incurring a taxable consequence.
Just one more for me before I hand it back to Justin. I wanted to ask you more general about this idea of a free lunch, because one of the things we've seen recently is people have done really, really well with a portfolio of stocks and bonds for 40 years. And now that inflation's back, you're seeing some arguments. You need more than stocks and bonds. You need some gold. You need something that does well in an inflationary environment. And I'm just wondering, what do you think about these arguments that the 60-40 portfolio may not work as well going forward as it has in the past?
Well, I think the problem is not necessarily the 60-40 portfolio, but what goes into the 60 or the 40 part. We currently have a recommendation of 45% U.S. stocks, 15% international, 25% bonds, 10% cash, but 5% commodities. And those commodities can either be hard assets like gold, or can be digital, such as Bitcoin, cryptocurrencies, etc. So, the feeling is, if you're nervous about the valuations of large cap US, then yes, look to overseas opportunities, because they continue, especially developed international, continues to trade at a double-digit discount to the relative PE over the last 20 years. And if you're looking at inflation as a concern, you probably want to keep the yield curve, at the shorter end, but also look to those assets that will do well in a rising inflationary, or at least a stubbornly high inflationary environment.
The fifth rule is don't get mad, get even. What did you mean by that?
Well, that just indicated that over the long haul, the equal weight S&P 500 did better than the cap weighted 500. But again, since technology has really taken a leadership role, that has not been the case. In fact, the S&P equal weight 500 has underperformed the cap weighted 500 in 8 of the last 15 years. So it's the same with mid caps and with small caps. Traditionally, if Sir Isaac Newton were to come out with a fourth law, it would be for every level of return, there's an equivalent level of risk. And so, sure, you can own mid caps and small caps, just realize that the outperformance in terms of return, you're going to have higher volatility along the way. Well, unfortunately, in the past 8 of the last 10 years, you have had a lot of volatility, but not much return. So again, I think that's because of technology, and we're probably going to have to wait some time before that kicks in once again to therefore benefit the equal weight mid cap, small cap stocks. Right now, investors are going to stick with what works, and that's large cap tech.
I think there's that famous study also that shows with investor emotions that, you have the market return of whatever it is, 10% over time, but due to bad timing, because investors are emotional and they get scared during bear markets or they chase performance, they underperform the overall market. So can you just talk to, I guess, the importance of managing investor behavior and how you can go about protecting yourself against that?
Absolutely. Well, I'm fortunate enough to be invited every March to the University of Pennsylvania at the Wharton School to talk to the Securities Industry Institute. And I hold a class called Using Stock Market History as Virtual Valium, or in a sense, by understanding what happens in the stock market during bull and bear markets can actually help you sleep better at night. The two emotions that drive investors are fear and greed. And I'm a certain believer that fear is a greater motivator than greed. Hence the old adage that bull markets take the stairs, but bear markets take the elevator. Also, quantifying that, if you count up what percent of trading days experience 1% moves or greater, only 15% of bull market days have 1% moves, whereas close to 45% of bear market days have 1% moves. So, humans are emotional. And essentially, when the volatility gets too great, they say, get me out of here. But that's probably the biggest mistake they can make, because what I try to teach the listeners is the speed with which the market gets back to break even. The average period it takes to go from a new high to a 5 to 10% decline, or what I call a pullback, is only about a month and a half. To get back to break even, a similar time frame. To go from a new high to a decline of 10 to 20%, as we just experienced, normally it's 4 months down and 4 months back up. Well, this time around, it only took us 2 months in each direction. One reason is because the speed with which we declined, we fell into that 10% mode in only 22 calendar days versus the more normal 80 calendar days. So being aware that swift equals shallow and usually a quick recovery, I think would have stopped a lot of investors from bailing out at just the wrong time.
So your next one is don't fight the Fed, which, I think means you were a fan of the great growth investor, Marty Zweig, who coined that phrase back in the mid 80s.
Oh, yes. Of course, I don't wear plaid and stripes the way he used to on TV, but a lot of people have learned an awful lot from Marty Zweig. You don't fight the Fed, because traditionally, over the long term, lower interest rates are positive for stocks, primarily because you can borrow money more cheaply to invest in the market, and chances are your returns from that stock market will well exceed the cost of that money. What we've also found is that at least early in the shift from a rate tightening cycle to a rate easing cycle, wishing is more rewarding than having. What I mean by that is looking at the 1 year period after the last rate hike and the first rate cut. The S&P gained an average of 18%. Yet in the 12-month period after the first rate cut, the market gained an average of only 5%. And that's because, the Fed might have waited a little bit too long to start cutting rates. It did start to cut rates because the economy had slowed. And in at least 2 instances, it was on the precipice of a recession and a new bear market. This time around, we're actually doing fairly well. The S&P is up 13.5% since the last rate hike back in July of 2019. First rate cut that we just saw at that point in time. So essentially, we've done fairly well this time, but usually lower interest rates are positive for stocks in general.
Do you and the team at CFRA have any base case scenarios on the Fed policy in sort of the second half of this year?
Yes, I think, like consensus, we think that the Fed will do nothing at the July meeting. Maybe at the press conference, Fed Chair Powell will start to sound a little more dovish, sort of paving the way for a rate cut in September, and then maybe a second 25 basis point cut in December, and then maybe 2 more cuts in the first half of 2026. So we don't see the Fed raising rates, certainly. And what has been the bane for investors is that the economy has remained fairly resilient, whether it's GDP growth, employment trends, inflation readings, et cetera. And as a result, the Fed, which is very data dependent, has said, there's no need for us to cut rates if inflation is remaining stubbornly high and the economy seems to be doing fairly well. So we'll have to take a wait and see. But like consensus, our feeling is they will cut twice this year, September and December.
So I'm glad to know number 7 is actually not attributable to Jim Cramer, and this is a Sam Stovall rule, which is there's always a bull market somewhere.
Well, and I'm sure go back even further than that, and it could have been many other people who had coined phrases like that. So basically it just implies that there's always some place that seems to be working. And what I try to do is I let the market be my guide, if you will. In a sense, it's almost like the let your winners ride, but instead of looking at it from one year to the next, looking at it every month. At the end of every month, I look back about 10 months, which is like a 200-day performance. And then I say, well, which have been the 4 best performing sectors and the 4 worst performing sectors? And what if I had a hypothetical portfolio where in equal proportion, I owned the 4 best performers and then I held them for a month and then reevaluated. So every month you look at your 4 best performers, take out the one that is no longer in the top 4 and put in the one that is. And since 1990, the performance has been fairly impressive. The S&P posted a compound annual growth rate of 8.8%, whereas this strategy was up 10.8%. Focusing on the losers, you only got about 5.9%. And again, going back to Pavlov's dog, this technique ended up beating the market about 2 out of every 3 years by focusing on the winners, whereas you beat the market only about 1 in 3 years if you were to be focusing on the losers.
This has been great, Sam. In closing, we always like to ask our guests sort of one of 2 standard closing questions. And so for you, what I'd like to ask is, based on your experience in the market, what's the one lesson you would teach your average investor?
Well, actually, it'd be 2 things. First off, do not rule out history. History, I think, is a wonderful guide. Although it's never gospel, it is a very, very good starting point. Because until we remove the individual investor from the investment equation, emotions will always exaggerate moves to the upside and to the downside. And my second recommendation would be try to extract your own emotions from the equation and remind yourself of the speed with which the market gets back to break even. Declines of up to 20% have taken an average of only 4 months to get back to break even since World War II. So by the time you worked yourself up into a frenzy, you started harassing your financial advisor to lighten up your equity exposure. By the time your advisor said, okay, I'll do it just so long as you stop calling, is probably the time at which the market has already turned and started to work its way back to break even.
Thank you very much, Sam. We appreciate it.
My pleasure. Good to talk to you guys.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.